Today, we will talk about expenses, definition, types, and how expenses are recorded. An expense is the cost of operations that a company incurs to generate revenue, or simply put, it is the cost one is required to spend on obtaining something. For example, common business expenses include payments to suppliers, employee wages, factory leases, and equipment depreciation. And a popular saying goes, it costs money to make money. One of the main goals of company management teams is to maximize profits. This is achieved by boosting revenues while keeping expenses in check. However, if expenses are cut too much, it could also have a detrimental effect. For example, paying less on advertising reduces costs but also lowers the company's visibility and ability to reach out to potential customers. Companies break down their revenues and expenses in their income statements. Accountants record expenses through one of two accounting methods: cash basis or accrual basis. For example, if a business owner schedules a carpet cleaner to clean the office, a company using the cash basis records the expense when it pays the invoice. Under the accrual method, the business accountant would record the carpet cleaning expense when the company receives the service. Expenses are generally recorded on an accrual basis, ensuring that they match up with the revenues reported in accounting periods. Operating expenses are the expenses related to the company's main activities, such as the cost of goods sold, administrative fees, office supplies, direct labor, and rent. These are the expenses that are incurred from normal, day-to-day activities. Operating expense is deducted from revenue to arrive at operating income, the amount of profit a company earns from its direct business activities. Non-operating expenses are not directly related to the business's core operations. Common examples include interest charges and other costs associated with borrowing money. Non-operating expenses are separate from operating expenses from an accounting perspective so as to be able to determine how much a company earns from its core activities. Capital expenditures, commonly known as CapEx, are funds used by a company to acquire, upgrade, and maintain physical assets such as property, buildings, an industrial plant, technology, or equipment. The IRS treats capital expenses differently than most other business expenses. While most costs of doing business can be expensed or written off against business income the year they are incurred, capital expenses must be capitalized or written off slowly over time. According to the IRS, to be deductible, a business expense must be both ordinary and necessary. Ordinary means the expense is common or accepted in that industry, while necessary means the expense is helpful in the pursuit of earning income. Business owners are not allowed to claim their personal, non-business expenses as business deductions. They also cannot claim lobbying expenses, penalties, and fines. Examples of expenses include rent, utilities, wages, salaries, maintenance, depreciation, insurance, and the cost of goods sold. Expenses are usually recurring payments needed to operate a business. Expenses can be categorized in a variety of ways. Expenses can be defined as fixed expenses, such as rent or mortgage, those that do not change with the change in production. Expenses can also be defined as variable expenses, those that change with the change in production. Expenses can also be categorized as operating and non-operating expenses. The former are the expenses directly related to operating the company, and the latter is indirectly related. An expense is a cost that businesses incur in running their operations. Expenses include wages, salaries, maintenance, rent, and depreciation. Expenses are deducted from revenue to arrive at profits. Businesses are allowed to deduct certain expenses from taxes to help alleviate the tax burden and bulk up profits. Here are 5 key takeaways. 1. An expense is the cost of operations that a company incurs to generate revenue. 2. Businesses can write off tax-deductible expenses on their income tax returns, provided that they meet the IRS guidelines. 3. Accountants record expenses through one of two accounting methods: cash basis or accrual basis. 4. There are two main categories of business expenses in accounting: operating expenses and non-operating expenses. 5. The IRS treats capital expenses differently than most other business expenses. Hope this would help. Thanks for watching.